Investors in fixed income products are a rather unsatisfied and confused lot. They are unsatisfied given the fact that the yields on many debt funds and fixed deposits are not even matching the inflation rate, and confused given the high volatility in bond yields and a difficult to predict interest rate cycle. Quite simply, these investors are on a quest to find a high quality fixed income instrument that comes with low interest rate and credit risk, that offers good liquidity and tax efficiency, and above all offers strong visibility of returns. In other words, these investors are searching for the recently introduced target maturity funds, which shall be our topic of examination and discussion in this video. The target maturity funds are debt mutual funds that invest in a portfolio of high quality bonds of a defined maturity. The most obvious part of this definition is that the funds have a specific maturity period that it is targeting, which is done by having bonds in the portfolio whose expiry date is very close to the target fund's maturity. For example, the IDFC Gilt 2027 Index Fund predictably invests in bonds that are maturing in the year 2027. In fact, the IDFC website specifically mentions that the scheme invests in instruments that mature on or around 30th of June 2027. To substantiate this, we even looked at the fact sheet and found that the scheme's assets were invested in two Government of India bonds, both of which were maturing on 15th of May 2027. Simply put, this defined maturity period is the core part of a target maturity fund, which makes this instrument ideal for investors who have a particular time horizon in mind. In fact, the construct of these funds is such that the bonds that the fund invests in are held until maturity, which means in theory, an investor is paid back the principal and the interest that is earned along the way. However, that does not mean that the principal is guaranteed, and like all mutual funds, there can be capital loss in these funds as well. In addition to having a defined maturity period, target maturity funds generally invest in bonds which have a high credit rating. For instance, the IDFC Gilt 2027 Index Funds holdings are in Government of India bonds, which in essence means that this fund has very low credit risk. However, other fund houses like Edelweiss and Nippon India, who also offer target maturity funds, have taken to invest in other types of debt instruments, mostly comprising of PSU bonds or state development loans. While PSU bonds are quite popular and have been in use in other debt fund categories, we were keen to know a bit more about state development loans, and here's what we found. State development loans, or SDLs, are borrowings made by the respective state government to fund their fiscal deficit. From a safety standpoint, most experts consider SDLs to be as safe as Government of India securities, and that's because states are considered sub-sovereign, which means there is an implicit sovereign guarantee on these SDLs, much like any Government of India bond. Incidentally, SDLs offer higher yields to investors when compared to the central government issued securities, which might be the reason for Edelweiss and Nippon India to prefer them over the central government bonds. So anyways, that's a little background on SDL, which I hope will help us understand the relatively safe nature of target maturity funds from a credit risk perspective. Another interesting characteristic of target maturity funds are its passive nature. After all, these funds hold a collection of bonds that are a part of the index they track. For example, the IDFC Gilt 2027 Index Fund invests in the constituents of the CRISIL Gilt 2027 Index, which also doubles up as the scheme's benchmark. In fact, the name of the scheme itself is a big giveaway of the benchmark they track, as we can see here with the Edelweiss and Nippon India offerings as well. So in essence, the securities which form part of the scheme's portfolio are expected to have the same characteristics as that of the underlying index in terms of the maturity profile and the type of securities. To some extent, target maturity funds are quite similar to fixed maturity plans or FMPs, barring a couple of major differences, which are: One, FMPs are closed-ended while target maturity funds are open-ended, which offers investors more liquidity. And secondly, FMPs have a maturity period of 1 to 3 years while target maturity funds are available for longer durations. If you've learned something new today, then do tap on to that like button and don't forget to subscribe to the ET Money YouTube channel to discover many more videos on investing, mutual funds, insurance, and other finance related topics. Target maturity funds present a number of benefits. The first benefit is something we have already discussed, that is, these funds come with negligible credit risk, and that's because their holdings comprise mainly of government securities, SDLs, and PSU bonds. The second benefit of these funds are its low impact to interest rate movements, and this is on account of the hold on to maturity or accrual strategy that these funds follow. A third benefit is on account of the low cost structure, as target maturity funds generally adopt an ETF or an index fund structure. As a result, the expense ratios are considerably lower when compared to other schemes like FMPs or medium-term gilt funds, which is again a plus point for these funds. The fourth benefit is the tax efficiency offered by target maturity funds, which proves super handy when comparing to traditional investment avenues like fixed deposits. So while the interest on a fixed deposit is calculated at one's prevailing income tax slab rate, which can be as high as 30%, by virtue of it being a debt fund, long-term capital gains on target maturity funds are taxed at 20% with indexation benefits. This can really bring down one's tax liability, which then improves your post-tax returns as illustrated in this table here. If you're not sure how to do indexation, then do check out an article we have posted on the ET Money blog, which explains how one can use indexation to reduce taxes. The fifth and the final benefit, in our view, perhaps the strongest USP for target maturity funds, is the predictability of returns that investors receive if they aim to stay invested until the maturity of the fund. In fact, some articles we read as part of our research provide an indicative annualized return of between 6 to 6.5% for most of these funds over a 5 to 7 year time frame. Of course, these indicative returns were calculated in the month of May, and there is bound to be some upward or downward revision to this. We'll discuss a little more on this in a later section, but these are the 5 strong reasons supporting target maturity funds. It's always a good practice to look before you leap. However, in the case of target maturity funds, the looking part is a bit tough, and that's because this type of strategy, at least from a specific fund perspective, is very new to the industry, which means we don't have a performance history of any of the schemes we have listed earlier in this video, and this becomes our first shortcoming with target maturity funds. A second concern of these funds is the limited room there is for fund managers to work on. And that's because the fund needs to pick securities of a specific maturity and from a particular index, which can really restrict the universe of eligible and available instruments. A third consideration here relates to cases where investors don't hold the fund until maturity. In that case, their investment in target maturity funds might be affected in a positive or negative direction due to the changes in the interest rate movements. So 3 concerns to look out for: no performance history, limited universe of securities, and possible interest rate risk. Let's look at what's happening around us. Inflation is increasing, further interest rate cuts are not likely to happen, liquidity measures are unwinding, and interest rates on fixed deposits and short duration debt funds continue to remain low. In a period like this, target maturity funds sure look tempting, and if you are a fixed income investor with a medium to long term horizon, you can certainly consider having these funds in your portfolio. Now, earlier in the video, we said that these funds give a fairly good idea of the returns one can expect, and the number you need to look at is the fund's yield to maturity, or YTM. The YTM of each of these schemes is available in the mutual fund company's monthly fact sheets, and gives investors a decent indication of the returns one can expect from the scheme if held until maturity. Of course, what's listed in the fact sheets will be the gross YTM. So to know the actual returns, you need to calculate the net YTM, which is nothing but the gross YTM minus the expense ratio. So if the net YTM is higher than the corresponding fixed deposit, then you can consider investing in a target maturity fund. Another piece of advice for investors is that one should invest in target maturity funds with the prime objective of holding onto it until its maturity. But if you're looking at these funds to time the interest rate cycle or take calls on the movement of the yields, then these might not be the right funds for you, and you're probably better off investing in gilt funds instead. I mean, every fund has its purpose, and substituting one with the other often leads to unwanted complications. So that's something that everyone should be aware of. But overall, we think target maturity funds does represent a promising category to fixed income investors, as they come with many advantages over the traditional instruments, especially given the current climate. And with this, we come to the end of this video. If you'd like to invest in the schemes we've highlighted in this presentation, do download and install the ET Money app. And while you're at it, don't forget to access the all new Learn section on the ET Money app, where we feature our best articles and videos to help accelerate your financial knowledge on investing, personal finance, insurance, NPS, and many related topics. So do check that out, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.